This is the current federal tax development for the week of August the 10th, 2026. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and I'm here this week talking to you about some stuff that's gone up here in August. It's actually been way more involved in terms of developments in August than traditionally we tend to see, but probably not a bad thing. So we're going to start with this with proposed regulations. These are regulations 115145-25 that establish transition rules for specified foreign corporations that faced year-end shifts after the repeal of IRC Section 898C2. Right, so this is basically here. The proposed regs, they're going to be found in the Federal Register published on July 31st. And again, fixing up these things and also involve changes made in the One Big Beautiful Bill Act, although I now believe I'm seeing it referred to in at least one IRS audit guide as the Workers' Tax Cut Bill or something similar. Whatever it is, yeah, we're going to see it. I take it that kind of means that One Big Beautiful Bill Act is now considered to didn't poll well anymore. So we've kind of with a new title. So whatever. I'm starting to call it the One Big Beautiful Bill Act because we've been doing that since day one. And, hopefully you don't make up your decision as to what to vote for in an election by the name of the bill. We're just going to say. So I'm hoping that that's part of it. We'll leave it there. So anyway, the section 7352 of that bill repealed the 1-month taxable year deferral election for specified foreign corporations. And those corporations had to transition to end their taxable year at the same time, basically as their majority U.S. shareholder. And SFCs, those are the specified foreign corporations, utilizing this 1-month deferral will face a short taxable year that was typically December 1st, 2025 to December 31st, 2025. Yes, I realize that's in the past, but we're a little behind in regs, so we're getting there, right? Now, there was a tax accounting problem here that they were trying to solve, and we've kind of known the direction the service was going to be going for a while, so this isn't exactly news to anyone, but we'll go ahead and we'll give you kind of the background here of what's going on. The real issue is foreign taxes paid or accrued by the SFCs are recognized at the end of the foreign taxable year. With the compressed short years, a full year of foreign income tax would accrue in a single U.S. tax month. That's going to cause you some real problems with foreign tax credit. So this tax accounting mismatches and a potential loss of foreign tax credits for U.S. shareholders because we got this big blob of tax in 1 month. And yeah, you can see how we're going to have a little problem here with this structure. So rather than allowing any reasonable method to allocate, the IRS is going to mandate a strict single allocation methodology based on foreign law taxable income, which takes and looks at existing rules in Treasury Regulations 1.1502-76B. 1.152 has a lot of subregs. We're just going to phrase it that way. And withholding taxes and cash method corporations are excluded from this, right? So, specified foreign income taxes, right? We've got this issue defined as a foreign net income tax accrued without regard to this section by an affected corporation in its first required year under an accrual method. The allocation percentage formula is determined by multiplying the foreign net income by a fraction. The short year's foreign taxable income, the numerator, over total foreign taxable income, the denominator. And key exclusions from the allocations: foreign withholding taxes, which accrue close to payment, and cash method SFCs are excluded to avoid unnecessary administrative complexity. Okay, now, I'm going to kind of walk through a mathematical illustration of the 10% disallowance here, right? On post-transition GILTI PTEP, in essence, distributions. Now, the GILTI deemed paid credit of 90%. Under Section 7312 of the One Big Beautiful Bill Act, it increased the GILTI deemed paid credit percentage from 80% to 90%, reducing the tax haircut to 10%. Now let's go to Section 960 D4's disallowance, the 10% disallowed. This disallowed 10% of foreign taxes paid, accrued, or deemed paid on distributions of post-transaction GILTI PTEP after June 28, 2025. And now there are the dual tracking rules, the accounting updates. This divides Section 951 Cap A PTT groups into pre-transitions ending on or before June 28, 2025, and post-transitions ending after June 28, 2025, to preserve the accuracy, right? So, bottom line, so this is essentially where you got a 150x distribution. Always love that in the way that we do examples. We're going to get $30 of withholding tax. $20 of the tax is attributable to post-transition PTP and is subject to a 10% disallowance. So it saves 18 as a credit, 2 is disallowed, and the remaining 10 is fully creditable. Okay. So again, if that impacts you, those regs, it's time to be digging through and do that. Luckily, I expect it doesn't impact most, so we're not going to do a lot of deep dive there. If it impacts you, it's a specialized area. It's time to go digging into it. Let's go to a private letter ruling, 2026-31001. Now, this is a non-taxable status of direct transfers that partitioned an inherited IRA between estate beneficiaries. And this is kind of interesting. We've seen a few of these rulings now come out of the IRS recently. This private letter ruling was issued on July the 31st, and it impacts Section 408, subsection D1, and subsection D3C are the key impacted areas. Now, let's kind of talk about what was going on here. In this case, the decedent had a traditional IRA, which was labeled X in this letter, and a Roth IRA labeled Y. But the decedent failed to designate beneficiaries because, of course, I just have to do that before I die. Well, sometimes you die without knowing it's going to be happening in the next, 20 minutes. Just didn't understand that. And this morning, when I'm recording this, it's Sunday, and yeah, it might be a little tough to get somebody on the line to change your beneficiaries, but okay, whatever. So in that case, under the terms of the IRAs in question, the estate became the beneficiary. So now we go look at the will. The decedent's will split the residuary estate equally between two taxpayers, A and B. Again, in PLRs, we always substitute names because they're published, but they need to be redacted, so there's no private information. So we always get A's and B's in this thing. Taxpayer A, one of the beneficiaries, was administrator of the estate, and taxpayer A proposed dividing these IRAs as it's equally. So what exactly was being proposed? A said, we're going to divide, the two IRAs, the regular, traditional, and the Roth, into two separate sub-accounts by means of a direct trustee-to-trustee transfer. Each transferee account will be decedent or, deceased, name of the decedent, deceased. So John Smith, deceased, IRA for the benefit of beneficiary as beneficiary of estate, the name of the estate. Okay. And so we're going to end up with essentially, 4 different IRAs. Traditional IRA that, for beneficiary A, right? A traditional IRA, therefore, for beneficiary B, and the same thing on the Roths. One for A, one for B. We get everybody into this mix. Okay. Now, let's go ahead and talk about this. Going back to Revenue Ruling 78406. It's been around. A direct transfer is a mere change of trustee, not a distribution. And the IRS extended this logic to an estate administration when the estate is the named beneficiary. So, a direct trustee-to-trustee transfer is, if you've not heard that term, a direct movement of funds from one IRS trustee to another IRS trustee. Does not constitute a payment or distribution. Now, IRS later, after the 78 ruling, began using the term direct rollover. So we're going to kind of go that way, but it's not really a rollover, right? Got this weird structure. Now, inherited IRA rollover exceptions under Section 408, subsection D3, are unavailable to non-spouse beneficiaries, making distributions followed by a rollover fatal. Here's the problem. Under the law, a rollover is technically taking the money out, putting it in your own bank account, and then putting it into a new account. This is why I understand why they called them direct rollovers, because for the general public, it was confusing and trustee-to-trustee transfer, because there is no trustee, it says custodian. It's like, okay. It's confusing for the general public. but technically you cannot roll it over. But what you can do is do a trustee-to-trustee transfer, which, as I mentioned, the IRS has confusingly labeled that concept a direct rollover. So we'll be there, although don't really call it that if you're doing this. But conceptually, yeah, it's the same thing. And there is a control and use standard because the transfer of funds remain within custody of the trustee and are never within the direct control or use of the taxpayers, beneficiaries in this case. The transaction is non-taxable. Remember, if you basically are a beneficiary of an IRA, non-spouse beneficiary, money comes out of that IRA after it's come to you as the successor. You can't take money out and then put it back in. So we got to avoid that. So the question was, how can we structure this without having to keep the estate around for an extended period? Right. So as we say, here's basically, this is the technique that was used, right? And some key issues. There are some key issues to take from what they did here and what the IRS approved. First, it definitely is, transfers accounts must preserve the beneficial identity of the estate and their title. Decedent for benefit of beneficiary is beneficiary of estate. It's going to be a real long title for the account, right? Now, what are the RMD rules on this thing? Well, 401A9 still covers it. The division of the IRAs does not alter or relieve the fiduciary of satisfying the requirement of distribution rules post-transfer. And this is going to be basically tied to the life expectancy of the decedent on the day he died. That's going to be your best option to stretch it as far as you can. Now, I realize that's a strange concept. The guy is in the coffin. How does he have a life expectancy? Well, it's kind of like if he hadn't died, which is a big exception, but that's what we're using under this concept. And remember, the real problem here is you got to don't go run off and do this on your own. Remember, under section 6110, subsection K3, a private letter ruling is binding only on the requesting taxpayer. So it does let us know what the IRS is thinking. But the bottom line is you probably don't want to, just go do this. And the trustee probably isn't going to balk at just having you do this. The bad news is if in fact our decedent, we'll call him Bob, if Bob, failed to designate a beneficiary, then we're probably going to have to take some money out of Bob's estate to pay for a private letter ruling to get the blessing to get these accounts out. That was what this taxpayer had to do, right? That's what this estate had to do. But they got it approved. So it's possible. Again, because of the cost of private letter ruling, if we're talking about a $10,000 IRA account, it's not going to be worth the bother. Almost certainly, because not only is there whatever fee you've got to pay the IRS, but there's also the minor problem of what you have to pay somebody to shepherd this through under professional fees. So at that point, we're probably just better off, taking the hit, taking the 10 grand out right now. And that allows us to close the estate. Everything's done. So yeah, be realistic. But we're talking about, $1.5 million in the account, then it's probably worth the bother. That's how I'd phrase it. Well, we're going to go on now to a case here. This is the Zhang versus Internal Revenue Service case. This was case number, in this case, 26 CV 00525 VKD. This is from the Northern District of California. The opinion came down July 30th. And this is going to deal with Internal Revenue Code section 6039 cap F, where the F's on the end of the title, right? Now, Ms. Zhang in this case was assessed over $720,000 in penalties. And that's going to be key here. We're looking at this. So we got a lot of money involved, right? And she's going to try to plead ignorance of the law as reasonable cause for her not complying with the rules. And unfortunately, that doesn't quite work. So she's going to try a different route. The route doesn't work, but hey, at least you got creative. So what did Ms. Zhang do? She relocated from China to the United States for graduate school, and she received foreign gifts exceeding the $100,000 in 2017. That triggered reporting, right? And she failed to file Form 3520 to report the gifts. She was completely ignorant of the 6039 cap F reporting rules. like probably a lot of people are. But yeah, if you've got somebody coming in and receiving, large gift from overseas, $100,000 or more, we got this rule we got to worry about, right? So she filed the late returns, eventually figuring it out, and IRS assessed the statutory maximum penalty of 25%, which totaled for her $723,993. It was a little bit over 100 grand that let's say well over 100 grand she got. So we go there. Now, the taxpayer tried to get out of this, right? The IRS rejected her reclaim for relief, saying, well, I had reasonable cause. I didn't know. I was ignorant. Ignorance of the law is not a good way to plead reasonable cause. Remember, reasonable cause generally requires a taxpayer showing that they took every reasonable step to attempt to understand the reporting requirements, and they still failed to comply. Simple ignorance of the law is going to help you. The idea being that from the services perspective, well, you just received, in this case, 4 times over 700 grand. So, 2.8 million plus. You probably, should have wondered if there might be some reporting issue of some sort. Would the U.S. have any sort of reporting or tax regime on this? Had you inquired of a tax professional who does work with the foreign tax area, you'd quickly run into, yeah, we got to file this form. But she didn't do that. She said, I'm just a poor student. Well, 2.8 million of 2.8 million of gifts. Poor student also is not going to get a whole lot of sympathy. Hate to say it, but it's kind of the way it works here. So she instead sued the IRS under the Administrative Procedures Act, alleging arbitrary and capricious agency action. I will give her or her counsel credit for creativity. Unfortunately, it's not going to work here, but it was creative. She sought a declaratory judgment to vacate and set aside the penalty assessments. So that's where we stood. That's how this case ends up before the court. Now, there's some key things to understand here, which is the sovereign immunity analysis here, right? In this case, remember, the United States, this goes back to, as I recall, English common law, you cannot sue the king without the king's permission. In the U.S., that translates to the federal government or the government without the government's permission. The United States is immune from suit unless it expressly waives immunity. Administrative Procedures Act waives immunity only for non-monetary claims under strict limits. The monetary claim waivers are separate, but she's going down the APA because, reasonable cause is probably not going to work. She could have tried to file a claim there, but yeah, it's like we're not going down that path. Now, under Section 704 of the APA, judicial review is restricted to final agency actions for which there is no other adequate remedy in court. And here's the problem. You can bring a civil suit for refund of this penalty. A civil tax refund suit under Title 28, United States Section 1346A1 provides an adequate alternative remedy. And it says, as a matter of law, that means the Administrative Procedures Act cannot be invoked in this case. So, not good. As I said, we've seen a lot of creativity with the APA, a lot of cases where it's been used because the courts have been a little broader. But this is pretty textbook of you're not likely to get there. You can sue for the refund. It's kind of backdoor what she's doing here, but they just don't like the law over there, right? The law for a reasonable cause is going to be tougher for her to succeed under, so she's trying to come over here. Like I said, creative, but really one of those, old style Hail Mary passes. And yeah, it fell incomplete like they normally do. That's where we're at. Next up, some more issues here. Or I should say, now, and they also barred her from amending her claim because she had 2 adequate alternative remedies. She could do a refund suit or a collection due process, right? And also the 10-year statute of limitation of 6502 also applies. What was the issue here, right? Well, what she could do is she could pay the full amount, right? Under the Flora rule, file a refund claim with the IRS, then sue for recovery. Now, a failure to prepay. There's no excuse. The taxpayer is fair to comply with the statutory scheme by failing to prepay the penalty does not render the refund pathway inadequate because she didn't really want to pay that, right? Now, alternatively, if she's not going to pay, there is another route here. She could go, and wait because the IRS hadn't formally yet to, initiated collection actions, right? So she could wait for them to initiate collection actions, request a collection due process hearing, which does not require prepayment, and then go to tax court. So she had an out even without paying, right? Now she's saying, but the IRS is not doing anything. And she's got this this problem of just not understanding, or basically saying, I can't really go on my life. The court said, well, there's a 10-year statute here. If they don't take action by the end of 10 years, they're going to lose the right to get the money from you. So, but until they initiate collection action, you can't do the CDP. So if they just sit there with this and do nothing, then you're just kind of in a bad position. So, you just got to kind of wait there. But, after 10 years, it will go away if they don't do something. And if they do something, then you've got your path to go to court, have your day in court, and not have to prepay this. Yeah, there's interest and stuff running in the interim. Yeah. So if they do come after you, it'd be for a bigger number, but life's not fair. Remember, you can't sue the sovereign except how the sovereign says they can be sued. And your options to sue the sovereign here is the APA doesn't work. So either pay it and then file a claim for refund, or go the CDP route. But then you got to wait for the IRS to initiate collection actions. That will trigger your ability to go down that path. Yeah, great. Not great. Now, in this case, we're going to have a California case because I love these California cases because we all have to deal with state income taxes. And the state of California is known to be relatively aggressive at looking for whether or not, the franchise tax board likes to look afar and figure out why they think income is California's source. So this is a multi-state executive compensation case, right? And basically in this case, we're going to have a CEO that relocated to Nevada, signs a release, gets 3 types of payments, and now California is saying all what he got paid was California's source. So this involves the case of the appeal of J. Otting and Y. Otting. This is OTA, Office of Tax Appeals, case number, in this case, 2309-14221. I get it straight. California Office of Tax Appeals in 2026, right? And then this refers back to a prior case, the appeal of McAneely, okay? Now, let's go to the basic dispute. Mr. Otting was CEO of One West Bank. After its merger with CIT Group, he accepted a CEO role with $1 million annual salary. His employment was terminated December 31st, 2015, and he relocated from California to Nevada on December 9th of 2015. So basically, he was told, we're going to, we're going to kick you out as CEO at the end of the year. So December 9th, basically, in this case, 22 days before his job ended, he relocated to Nevada. In 2016, the next year, as a Nevada resident, he received 3 distinct payments: a severance payment, a medical premium reimbursement, and restricted stock unit vesting payments, right? Now, the question is, what, if any of that, is California's source? Mr. Otting's theory was none of it was. The Franchise Tax Board's theory was all of it was. And we're going to find that the OTA is going to give us an answer that's in the middle, and we'll talk about how this works out. So under the California Resident Revenue and Taxation Code, RNTC, that's right, get that right, Section 17951, that sources compensation for personal services to California. Now, Section 17952 sources income from intangible personal property, contracts rights, to the state of domicile. And there's no question Nevada was his state of domicile. Okay. The Franchise Tax Board audited and assessed $1.8 million of taxes, claiming all payments were California-sourced wages for personal services. Okay. Now, there is this case called McAneely. Okay. McAneely established payments received by a non-resident for early termination of employment contract are treated as income from intangible contract rights. And the OTA is going to follow this procedure. Even if an employee is at will, a contract containing specific enforceable rights to compensation upon termination will trigger the McAneely rule. Okay. And under the domicile sourcing rules, an intangible contract right of a non-resident is sourced to state of domicile. In Nevada, unless the FTB can establish a California business situs. That's going to be the case. Now, in this case, the court ruled a nationwide non-compete and general release covenants fail California's localized business situs standards. Okay? So this is the Raytheon origin of the claim doctrine of California law. It went through the release, right? And so what happened there was under, basically R18, Regulation 18-17-952C, intangible acquire a California business situs only if employed as capital there or localized in connection with a business in California. Under the Raytheon doctrine, characteristics of a settled claim is derived from the character of the underlying claim itself. The release terms must be analyzed individually. And in this case, they tied the actual severance payment here to Nevada. Covenants not to compete were nationwide. General release clauses in that contract lacked localized and California connection. Therefore, the severance was localized to Nevada. Now, the RSUs he had kind of earned while there, so he had a partial loss there. But these other rights, they were considered Nevada sourced. That was their origin, right? So we get to the RSUs. There they said, look, right? They said vested RSUs, the services are rendered in California. This is California source. Unlike the forward-looking analysis applied to severance, the rights to the RSU payments were backward-looking and directly tied to employment services. Remember, Mr. Otting rendered service as a corporate officer in California from the grant date to the vesting date of this portion of the RSUs. He had rights to the restricted stock unit. And compensated wholly attributable to employment in California, has business status in California, again, under Regulation 17-952, even if deferred or paid post-termination. So even though he received this payment after becoming a domiciled in Nevada, that payment related to services he performed in California. That made it a California source income per the state of California. So this is interesting because, again, the FTB, like they often do, went after everything. And it turns out that when we get to the Office of Tax Appeals, it was more nuanced than that. Okay, now here we go. A One Big Beautiful Bill Act change, one thing made in there, is Section 455, paid family leave and medical credit, was made permanent, and they added an additional premium calculation method for a way to add medical insurance premiums into the mix. And this is, guidance on this is in Notice 2026-28. It was issued on August 5th of 2026, interpreting, actually not 45, but 45S, and Public Law 11921, the One Big Beautiful Bill Act, or whatever we're calling it now. So the BBA eliminated the sunset provisions of Sections 45 Cap SI, which means it made the paid family and medical leave credit a permanent fixture of the general business credit. Right? So employers can now formalize long-term policies with permanent tax incentives to pay people while they're on this sort of leave. The credit requires a written policy providing at least 9 weeks of paid annual leave, 50% or more of pay to qualifying employees. Right? Now, in addition to the traditional method of looking at the wages you paid them, employers can now elect the premium method under Section 45 Cap S, subsection A1B. This could allow employers to calculate the credit based on commercial insurance premiums paid or incurred for paid leave policies. So this simplifies administration. The rate of payment is determined without regard to whether any qualifying employees actually took leave. Now, traditional wage method scales, the Apple credit percentage up to 25% based on wage replacement rates. Okay, so remember, we had to get to 50% to start. So it starts at 12.5% of what you paid them if the written policy provides a minimum 50% wage replacement normally paid to the employee. Then it increases by 0.25% for each 1% percentage point by which the rate of payment exceeds 50% of the normal wages. And that means eventually it's going to cap out at 25% if you have paid 100%. Full wage repayment. That's a maximum of 12 weeks. So that's how it goes together. Right? Now, notice 2026-28 does restrict premium credit to policies providing FLMA compliant credible coverage. That's credible coverage standard, and this is Q&A 1 through Q&A 5 in the notice. A premium is only eligible for the credit under the premium method if it funds a benefit for which a credit would be available under the wage method. Okay. Now, there's the FLMA purpose requirement. That means the policy's got to cover leave specifically designed for one or more of the Family Medical Leave Act purposes. General sick leave or short-term disability that fails the standard 45 cap SE test is non-creditable. And exclusions from the premium base. Any premiums funding non-qualifying employees, that is less than 20 hours per week of work, non-wage benefits, or state-mandated leave, which continues to be non-creditable, are excluded from this program. Now, also, employers must reasonably allocate the blended premiums. This is always a complication because many times we pay for lots of things with a premium. And we have to apply a Section 280 Cap CA deduction disallowance. Standard type of thing we see there that gets referenced to disallowed deductions for cases where you get credits by having to reduce your deduction by the payment. So there is a 4-step process involved in this. You first must identify any blended policy. Those are policies that provide both credible and non-creditable coverage or cover non-qualifying employees. Then you have to allocate the blended premiums. You allocate using any reasonable method that is consistent with policy terms and supported by contemporaneous records kept by the employer. Step 3 means you got to avoid double dipping. You can use both methods across benefit programs, but you cannot claim both wage and premium credits for the same instance of leave. And number 4, at disallowing the deduction to the extent of the credit. Under Section 280 Cap C subsection A, you have to reduce this deduction for the premiums and wages by the amount of the Section 45 Cap S credit, that is this credit for FMLA pay, that you've been allowed. Okay, next up. The tax court's going to rule in Big Apple. That's not just in New York. No, this is the Big Apple case. Big Apple Tompkins Realty, shall we say, that the 90-day filing deadline under the Bipartisan Budget Act, right, is non-jurisdictional claim processing rule. Remember, the tax court's been very, very insistent that under 6013A, we have a deficiency notice for a taxpayer. They're still fighting and saying that that is a, that's a procedural rule. And sorry, I don't care what your excuse is, there's no way out. But in this case, we have a little different background. This is the Bipartisan Budget Act examination of a partnership. Okay. So Big Apple Tompkins Realty, it's going to be called Big Apple through this, was subject to the centralized partnership audit procedures of BBA, right? Following the audit, the IRS issued a final partnership adjustment dated August 11th, 2022, assessing an imputed underpayment of $87,586 plus penalties. Now, taxpayer was a little late on the 90 days here. Taxpayer did not file a petition for readjustment until November 13, 2023, which was a whole 452 days. Actually, got longer than that, 273, I think was what we have, after the FPA date. It's like, it was very late. We're going to say this, right? It took a while. Okay. Now, here's the procedural clash. The taxpayer objected to the IRS's motion to dismiss, claiming it did not actually receive the final partnership adjustment until November 2023. The IRS said, we're moving for lack of jurisdiction, arguing the 90-day filing window in Section 6234A is an absolute jurisdictional line. Now, what we have to do here is decide, because the taxpayer is going to argue now for some sort of equitable relief. I should be able to do this. And this is tax court case 167 TC number 7, issued on August the 5th. The IRS is saying, no, this is just like 6013. You missed the date, and at least outside of, certain circuits, sorry, tough luck. We're done with this. So the tax court had to evaluate whether the late filing deprived the court of all power to hear the dispute. And we never actually had this before. Nobody argued for equitable relief in this case before, so we're going to kind of look at this, right? Okay. Now, court loves Latin terms, and my Latin is not good at all, but what is in peri materia? Whatever, construction. What that really means is we're going to evaluate this like similar rules, right? So they said the FPA mailing sufficiency rules must be construed in harmony with traditional deficiency notice procedures under Section 6212B1. And a final partnership adjustment is validly issued and mailed if sent via certified registered mail to the last known address, regardless of where the taxpayer actually receives it, right? And the burden of proof, the IRS bears the burden of proving by competent persuasive evidence that the actual date on which the FPA was mailed. That's key because this is following other concepts, right, in that case. Now, the tax court reject the prior construction canon because they're saying, well, under TEFRA, it was jurisdictional. So BBA just replaced TEFRA, so it should have basically the same rules, right? The court said, not really. It's very different. TEFRA deadlines were jurisdictional for some very solid reasons. TEFRA was highly partner-focused, requiring a distressingly complex web of deadlines. I mean, there were all kinds for multiple parties. There were deadlines everywhere under TEFRA, right? TEFRA contained detailed statutory exceptions, leaving no room for court-created equitable tolling. An equitable tolling of a TEFRA petition would require unwinding assessments across 100 individual partners, causing administrative paralysis. Remember, the problem here is the partnership wasn't quick enough to go in and say IRS got the exam wrong. In TEFRA, if we allowed the partnership, year plus later to say, oh, well, we had a good reason for not going. IRS be in the middle of, going after individual partners now because they only got 1 year to run it after everything gets set. And we'd have to kind of undo all of that, potentially even refund money that certain partners had paid, go back to square one and start all this over again. So the court said, that's what you had. BBA doesn't work like that. BBA is very strictly focused on the entity, dealing solely with the designated partnership representative. While the partnership can opt to go to the pushout, they do that. They're going to give up their rights to do this court issue, going down this path. The BBA's centralized structure has no multitude of statutory exceptions. It paves the way for equitable exceptions. In essence, we're basically still working this out. Late file petitions under the BBA do not cause administrative paralysis. They only pose headaches. Well, I guess headaches are headaches versus paralysis. I'm not sure that's the easiest test to figure out, but that's it. But they're saying under that, only headaches, and this meets the only headaches rule, under entity level assessment. Okay. So that works for us in this case. Now, there was an interesting ruling that's kind of in the middle of this case that was interesting. There was an unsigned IRS form, or I should say United States Postal Form 3877. The IRS lost their presumption of proper mailing, but at the end of the day, they could use secondary evidence to confirm the date they sent the notice out. This could be of use in other cases. So if the IRS doesn't have that secondary evidence, right? So they had a defective Form 3877. Remember, I've told you many times that when we talked about certified mail receipt, I need the white receipt stamped by a U.S. Postal Service employee. Let's say somehow your client mailed this document at the U.S. Postal Service, used certified mail, but for whatever reason, they walked out of there and the postal clerk had never stamped the receipt. That's a problem, really big problem. In this case, you basically, IRS had the equivalent of that white receipt, right? It was incomplete. It lacked a postal clerk's signature and article count when filled in totally, right? That stripped the IRS of the presumption of proper mailing. However, unlike the rates that we've talked about for timely mailing, where I really need that white receipt, right? Despite losing the presumption, the IRS could prove the mailing date via Virginia post office stamps, certified receipts, and matching tracking numbers. Not sure we could recover as easily on the other side. So really make sure clients get that stuff done. So bottom line, it was timely. So now they would go and decide equitable tolling. If we decide that that's the actual start date, IRS has met their burden there. They said, but here's the catch. 6234A has no clear jurisdictional statement. The deadline's non-jurisdictional. They denied the motion, but they reserved ruling that actually equitable tolling would matter. Please remember, we are still waiting for a case that actually ends up going to trial into something else. Because if the court indicates they're going to, they're considering the equitable tolling and it seems like they have a decent chance, the IRS could very well settle the case before the court ever went back and ruled that equitable tolling would apply. But we do know that, the original case that brought us here, Boehner was the case, right? Yeah, that case, that the Supreme Court that got CDP hearings, or CDP tax court filings were considered merely jurisdictional and we could fix them. Remember, she went all that way, she did all that work, and then went back to court and she still lost. They found out that she didn't have a good enough excuse. Yeah, that still overall the chances of them winning this is not great, but they're allowed to argue it, which is really what we've got so far. So don't tell people equitable tolling should never be relied upon. If you're using it, you're in trouble. It's kind of like using the Cohen defense. If we're down to using Cohen, we're in trouble. Same thing here. Okay. Now, here's a standard, and I just include this more because this is something that we tend to see. Taxpayer records are a total mess, but they want to be really aggressive. Yeah, this is a disaster. This is the case of Reed versus Commissioner, Tax Random Decision 2026-64, decision issued on August the 4th. Now, in this case, we have a consultant and a doctor. We have Scott Reed, who's a consultant, and we have Dr. Stacy Reed, physician, right? They had complex ventures in historic real estate, reclaimed wood, and dermatology. Dr. Stacy was the one in dermatology, right? The taxpayer did not maintain complete books and records for Reed Realty Advisors, a disregarded single-member LLC. And Scott frequently deposited and withdrew business funds using the couple's personal bank accounts. Yep, totally disorganized client doing 3,000 things at once and really, really wanting aggressive tax positions. This is not going to end well. Now, they shifted the burden of proof. The IRS's bank deposit analysis is prima facie considered correct once minimal substantive evidence of unreported income is introduced. For deductions, the burden remains unconditionally on the taxpayer under Section 6001 to maintain sufficient substantiation. And the court refused to apply Cohen here. So I told you we're in trouble with Cohen because cannot serve as a substitute for the basic burden of proof, right? We can estimate once you establish the fact that such expenses were incurred. Dr. Reed could not establish that fact to the satisfaction of the court. And also, I have a real difficult time believing there would be a reasonable basis upon which to estimate. Again, because it doesn't sound like these records were in good shape at all. Okay, let's go ahead and go down some of the specifics here, right? This is Reed versus Commissioner, and also reference to case in the past of LeBurk versus Commissioner. In this case, RRA, right, paid $228,000 to set up Dr. Reed's dermatology practice. It was disallowed because RRA is in real estate consulting. The cost for setting up her practice is not a deductible expense of his business. Yes, you do that, you've blown it, right? Remember, because of course he's trying to get various other things done, right, in that case, and reduce his self-employment income, all other neat things there. Now, the lower exception standards allow taxpayer to deduct expenses paid on behalf of another entity if the primary motive is to protect, promote their own business, and it's ordinary and necessary, but it failed here. The payments for the project entity's construction and repairs failed the test because Mr. Reed was an investor. There was no written agreement specifying RRA's developmental fees. They didn't document anything. So, they were going to pay him. He was going to pay for these fees. He's going to claim it's, to help protect interests. It's like none of that worked. Now, had Dr. Stacy's business incurred these, it's a different issue, right? And a guarantor's cash transfer are recharacterized as non-deductible capital contributions unless there's proof of worthless bad debts, right? In this case, right, we're going to have $811,000 of cash transfers to project entities were treated as non-deductible capital contributions or non-worthless loans. Now, Scott made these transfers in his role as personal guarantor. And the problem is you're bound by the form. In essence, for capital versus debt, you're strictly bound by the chosen legal form of the transaction. Transfers were recorded on the project's books as loans, not business expenses. See, he's trying to change his treatment now, right? Also, unreimbursed partnership expenses are not generally deductible. The operating agreement didn't provide for any sort of things here where a partner was going to be responsible for paying for loan expenses. Because the operating agreement or a routine practice that specifically required payment without reimbursement has to be shown. He could fail that with monies that went in for certain partnerships. And you got to prove a bad debt. Failed to prove that loans were worthless under Section 166. Those entities contained valuable real estate, and Scott failed to seek contributions from co-guarantors. Yeah, that's not going to work. So, bottom line, the form of these were loans he couldn't show were worthless, and when he tried to claim a deduction then under other theories, the court said, nope, you're stuck with the form. Okay, now this is SIH Partners, LLLP versus Commissioner, Tax Court Decision 167, TC number 8, August 6th. Now, this particular case is a partnership that did this internally, but we've seen a lot of variants of this now being promoted to taxpayers. The sort of way where we can come up with a magical loss to offset capital gains. Now, in SIHP, which is related to Susquehanna International Group, purchased hundreds of millions of dollars in Swiss equities over X dividend dates. Okay, they're doing this intentionally to set this up. They reported $170 million in gross dividends, claiming qualified dividend income preferential tax rates. Simultaneously, SIHB entered into a portfolio swap with Morgan Stanley that provided identical short positions in the Swiss equities. The swap also incorporated SIG's multi-billion-dollar pre-existing firm hedge. Now, they're trying to meet a safe harbor and claim that the tax offsets here are fine. Under the substantial overlap test, a portfolio position is considered to be, in essence, in this case, SSRP, right? Only if the overlap is 70% or more, and they need to stay below that because otherwise it's a problem swap. Due to dilutive effects of the multi-billion-dollar firm hedge that got snuck in here, short positions, the overlap was mathematically established to be just under 65%. Because 64.38% is less than 70%, SHIP technically complied with the plain text of mechanical safe harbor. And the court rejected the IRS's common law substance over form argument to disaggregate the swap because it was in the code. However, they're not safe at this point. The virtual tracking test sets aside the formal safe harbor, where the offsetting swap hedged 100% of the risk in the Swiss stocks. There's an anti-abuse rule in Treasury Regulation 1.246-5, subsection C1 VI. It's broad in application and is a catch-all for potential abuse. And the court's going to find that reg catches this, right? Virtual tracking does not require a strict 95% correlation or low deviation. That was what the taxpayers expert tried to argue. The court rejected that. They said, this is looking at a qualitative test, not a quantitative test. The offsetting swap provided 100% hedge on the Swiss equities, right? In that case. And that got rid of the risk of loss because the short Swiss positions in the swap perfectly match and offset the long Swiss stock. Changes in value were reasonably expected to virtually track inversely, right? So, and there was an expectation of tax savings exceeding the pre-tax profit, disallows over $100 million in qualified dividend income, deductions, and $25 million in foreign tax credits. Yeah. Let's look at IRC section 2246, subsection C4, and section 901, subsection K. Right. The tax savings that was expected. $25 million more of savings was guaranteed from the QDI preferral rate and the claimed foreign tax credits on the Swiss withholding taxes exceeding $25 million in 2012. Pre-tax profits. Pre-transaction analysis showed the expected pre-tax economic profit of only $0 to $2.4 million, and with a low-end loss of nearly $31 million because of the 25% Swiss withholding. So, because the tax savings exceeded the expected profits, the holding periods told, reclassifying $170 million of QDI as ordinary income and disallowing $25 million in foreign tax credits. Yeah, bad fact. So this is a problem, right, in the structure. Now, like I said, we are seeing a lot, and this is not the transaction being marketed. But I am just seeing way too many of these proposals and being asked about them. And I get nervous when something gets real popular. And when it gets this popular, we got a bigger problem. You begin to get Congress noticing it. And even if the IRS is successfully attacking it, which they, by the way, have now started to identify those as potential problems, they've yet to say they're listed transactions, but that may be coming, to basically put out a proposed reg to get them there. But I would have to warn any clients, when I first came into practice, first graduated college, started working in tax, I got assigned unwinding for a new client of the firm who had positions in what became 1256 contracts. Prior to the adoption of 1256 in the 1981 Economic Recovery Tax Act, that was a very popular method of use to just like be able to generate covering losses, right? And put off your gains forever. We're not going to go through the details of the structure there, but just realize when it unwound, all those gains were going to come flying out over, I think you had like a 5-year phase out period, if I remember how it worked right. Yeah. I'm a little worried that the 1256 style rules can start coming after some of these transactions. Not the current 1256 rules don't cover them, but Congress may very well shut this down. It's getting too popular. Once it gets too popular, it's likely to get noticed, and Congress is always looking for revenue offsets and shutting down, tax, what they consider, unintended tax shelters is a great way to get some money without making, the average voter mad. So it happens. Now, the IRS just issued as well, and this is a new fact sheet 2026-13, right? It is the updates to Q&As about the new deduction for qualified overtime compensation issued by the IRS on August the 6th, 2026. It covers Internal Revenue Code Section 225, which was adopted as part of the One Big Beautiful Bill Act. Now, we all know this, right? We had temporary rules in 25. This is updating it now for the rules that are going to apply in 26. So Section 225 allows hourly workers a temporary deduction for qualified overtime compensation received in 2025 to 2028, right? The maximum annual deduction is $12,500, $25,000 for married filing joint returns, and it reduces by $100 for each $1,000 by which a modified AGI exceeds $150,000, $300,000 for joint returns. Now, 1/2 premium portion of the FLSA required overtime is what you get to deduct. So remember, it's got to be FLSA required overtime. If you're in California, you're probably paying people overtime that's not FLSA required because they have more onerous overtime rules. So yeah, it's real messy if you're an employer in California to figure this out. And what this Q&A is going to point out to you, the fact sheet, is you're going to have to report that this year, right? But let's say, so if you're paid $100 an hour and you're on overtime, so you're being paid $150, the 50 being 1/2 of your standard rate. Well, if you're doing that, you're doing pretty well at $100 an hour. But if you're doing that, then yeah, we'd have it. FLSA overtime at that level seems unlikely, but still, we got it. But you'd get the $50 deduction, not the $150, right? Because that's the half of your regular rate. Now, the August update, right? Fact sheet 2026-13 updates the previous FAQ and supersedes the initial guidance on fact sheet 2026-01, which covered the 2025 reporting period, right? It's a transition from what was a flexible, taxpayer-friendly reporting of the 2025 transition year to a much more, focused on reporting items, things reported for 2026. There is a strict compliance-driven framework for the remaining years. For 26 through 28, you're going to have to be a little more in line with what's going on. Okay. So what we do is we delete the transition relief for 25, and we're going to make what's in your box 12 code TT on Form W2 mandatory. That is the deduction. If there is nothing in your W2 box 12 under code TT, you cannot claim the overtime deduction. If that number is too low, you cannot claim a higher number than that number. That number is going to be the absolute test, right? So let's go through the steps of this. Number one, transition period, the 25 relief is over. I know what you could do in 25. You're not going to do that for 26 individual returns, right? Individual approximation methods for pay stubs, daily logs are completely gone. You can have absolute proof that number on the W-2 is wrong, and it should be $10,000. And they didn't put anything in there. You're out of luck unless you can get a W-2C issued. Because for 2026 and beyond, employers must separately report qualified overtime in box 12 of Form W-2 using code TT. Now remember, if the employer doesn't do that, they can face penalties for not having filed proper and complete information returns on a timely basis. And those penalties can get nasty. So be aware, the employers have issues too. But the employee, if there is no box 12, there's no claim. Right? Now, that doesn't mean if you know box 12 is too high, you can just claim it. No, you're not going to get an out for that. You may get reasonable cause. You know it was too high. But if you know it's too high, you can't just claim box 12. Right? We need box 12 code TT. That's what we need this year. If that's not there, then the employee has to go back to the employer and demand a Form W-2C. You can't use the substitute Form 4852 These, basically this fact sheet makes that clear. Errors can only be corrected by asking the employer to give you a W-2C, modify the W-2s, modify W-2s filed with Social Security, and give you a W-2C. This is a compliance shift, right? Also, some other clarifications for 20% business owners and federal income tax withholding rules. Number one, an employee owns at least a 20% equity interest and actively manages a business is considered an exempt executive under FLSA. They are absolutely ineligible to claim overtime. So, I own more than 20% of my accounting firm. Even if I was somehow hourly, right, I'm being paid, there is no way I can claim overtime payments on any W-2 for my accounting firm I own more than 20%, right? That equity interest is there. Federal withholding, qualified overtime remains fully subject to federal income tax withholding. Employers may not reduce withholding unless the employee files an updated form W-4. There are some, instructions now with the W-4 that allows the employee to compute what kind of adjustments they could ask for. But the employer is not to do anything just because those TT wages are going on there, right? And also there's some clarification for federal employees. It outlines OPM regulations and clarifies how unused compensatory time off is treated as qualified overtime when it's liquidated and paid out. So if you have that case, federal employees will look there. That said, this has been our current federal tax developments for the week of August the 10th. Again, thanks for tuning in this week. Hopefully we'll be back next week with more developments. Already got a couple set up because a couple things came out Friday and this was already pretty full. So I'm delaying that until next week. We've got those. My email address, edzars@currentfederaltaxdevelopments.com. I also do pay attention to Connect's sites run by the Arizona, New Jersey, Minnesota, Idaho, and Washington Society of CPAs. So if you have some questions you post there, I may notice them, and if so, I might decide to post a response if I think I have something that could help. But otherwise, I want to thank you for tuning in this week. We hopefully will, like I said, see you next week on another week of current federal tax developments.